Okay, so I guess we will go ahead and get started. Um, Today's subject is on the stock market. And as you may have noted, people on the stock market found out that we were having this session this morning, and the stock market is going sky high just because of that. So the power that we have, huh? So we've got two great panelists to start our discussion and be our resource people. And as usual, we will have the good fortune of Terry Shelton's master emceeing and moderating of our discussion this morning. So Terry, you want to take it away?
Yeah, well, we're really happy to have Kyle Tetting and Tony Nichols. Kyle's going to kick us off here first. He's with Landaas and Company out of Milwaukee. And Kurt's going to put some bio information in the chat so you can see that for him, and also for Tony, I think, after Kyle. I think the format would just be let's these guys go for 10 or 15 minutes each with their slides and what they have. And then certainly your questions are welcome at any time. And of course, everything is open with this because this gets us back to our earlier conversation on modern monetary policy, everything was the role of the Federal Reserve, the role of the Treasury. This is sort of a continuation of that because so much is at stake. But anything basically, I think, is with these two type of folks with this, anything is fair game. Some of the questions I've written down already involve things from social investing to negative interest rates to whether the Fed's out of ammunition, what the pandemic has to do. We all want to know about day traders, maybe Bitcoin. And whether or not there really is a V-shaped recovery. So you think you guys, Kyle and Tony, can do that for us and get it all covered in 5 minutes?
We'll do our best. I'm sure that 5 might be a little bit of a stretch, but you give me 6 or 7 and I can give you the basics.
Take it away, Kyle.
And I'm going to share my screen here with everybody. Just, want to just give you a couple of what I think are some pretty important pieces here. And again, I think there's a tendency in these kinds of conversations with folks in positions like Tony and I to just give you a data dump, to just say, here's what we think is going on in the world. And here's, how that plays out for investors. I think the bigger issue, though, is that there are some broader themes developing. There's some broader conversations to be had. And so as we look at, just starting with 2020, I think the critical piece, just starting with the economy, was unemployment. You can't talk about what happened last year without talking about the 22.2 million jobs that were lost between the months of February and March. That were lost between the months of February and April. Now, we recovered a little more than 12 million of those jobs, but there are still 10 million people out of work. To put the 22 million in some perspective, though, that's 97% of the jobs created since February of 2010, essentially the bottom of the great financial crisis. That was kind of the last major collapse that we all dealt with as investors. And so you destroy essentially 97% of the employment gains since the last big recession. And yeah, we recovered a lot of that quickly. But, if you listen to what the Fed has been putting out, if you read any of the many major economists out there that have talked about this, many of those jobs are likely gone for good. And so that's a huge structural issue as we talk about the economy, is that, 2/3 or a little more than 2/3 of economic output is consumer spending. If you've got 10 million people still out of work, that's consumer spending that's not happening. And so as you look at the challenges of the economy for last year, it's absolutely employment, I think, that stands out. Of course, the other big piece of this, as you look at unemployment, is that about 40% of the jobs still that haven't returned come from travel and leisure. Those tend to be lower or middle income positions. They tend to be people that as a whole spend most of what they make. And so we know, based on studies, that about 99% of after-tax income is spent by people in the bottom 90% of earnings. The top 10% only spend about 2/3. And so if you take away, 10 million jobs, many of those lower middle income earners, it's almost a 1-to-1 removal of that of that income from the economy. It's almost an immediate impact on economic output. And so we certainly understand the reasons. People weren't willing to travel. People weren't willing to stay in hotels. But again, I think employment is the tell-all about what happened with the economy last year. Now, of course, need to stress that the economy is not the stock market. And so as we look at, really what happened in 2020 for stocks, there's two significant stories here. And so what I'm giving you here is the total return across all of 2020 for two of what are the large businesses out there on the value side of the market and the growth side of the market. And just to tell you what you can see right on the page, the Russell 1000 Growth Index up almost 38.5% last year. The Russell 1000 Value Index up almost 2.8%. When you talk about market returns, we have to begin to separate them from what happened in the economy. And so part of that story is the difference between value and growth. And just to put some color on that, value stocks tend to be slower growing. They tend to be more stable, more predictable businesses. And most importantly, people tend to like them because they can get them more cheaply. The other side of that, the growth, people buy them because they expect more growth from them, as the name implies. And I think most importantly, these are businesses that are maybe less mature, that have avenues for growth that those older, more mature value stocks don't have. And so what we saw is that as we got over the immediate shock of the pandemic, a small number of stocks began to rally pretty sharply. That was what essentially the market viewed as some pandemic-proof stocks. Those were some technology names, some media names, social media names, and a couple of what I think are some pretty, highly defensible consumer stocks. And you all have probably heard FANG or some acronym that tries to describe some of the stocks that have done well. The overwhelming trend behind a lot of those names is that not only were they pandemic proof, they may have actually benefited from the pandemic. And so you think of a streaming media company, right? You don't have to go to the store and rent a DVD anymore. You can get that straight to your home. When you're staying home more, you're probably going to pay for more streaming media services or pay for a streaming media service that you didn't pay for before. And so early on in the pandemic, once the initial shock wore off, and I want to stress that initial shock was significant, we saw a pretty swift recovery. Now, the challenge is that doesn't completely explain what happened later in the year. So many of you will recall that there were a string of Mondays in November where we got some pretty significant and positive news on vaccinations. Pfizer, Moderna, a few other less high profile names that came out with data on what the initial studies for the COVID vaccine looked like. All of a sudden, the market started to look ahead rather than to be mired in what had been a very pandemic-driven trade, a very pandemic-driven market. The market started to look ahead. Investors started to look ahead to, well, what happens once everyone's vaccinated? How do we get from an economy where nothing can happen unless people are comfortable going out and spending to an economy where all of a sudden there's pent-up demand, all of a sudden there's a lot of things that we didn't really have the confidence to do, but wanted to do, that all of a sudden we have confidence to do again. And so, as you can see on the chart that I've put up, that bottom line, the Russell 1000 value, late in the year, we start to see much broader participation in the stock rally. And so really two pieces here that you need to remember. Number one, and I'm going to put a finer point on this, the stock market is not the economy. When we talk about the growth stocks that ran as well as they did last year, I think it's worth pointing out that 38% of the S&P 500, so a broad measure of the largest stocks here in the US, 38% of the S&P 500 is technology stocks and communication services stocks. Communication services being the streaming services, the media and social media businesses, but that's 38% of the S&P 500. It's 6% of the US's gross domestic product, and it's 2% of total employment. So when I tell you that the economic story last year was the issues that arose from a massive amount of layoffs, a massive amount of job loss. That has nothing to do with stocks when 38% of broad market measures were driven by, again, 2% of the employment picture. The other side of this, as we look ahead, is that we are very much driven by expectations for the future. So what I've given you here is the forecast for earnings for the S&P 500 over 2019, 2020, 21, 22. So we know that 2019 earnings for the S&P 500 came in somewhere around $163 a share. We think that for all of 2020, we'll have taken about a 15.5, almost 16% step back in earnings. As an investor in stocks, what you care about is earnings. What you care about is, I own a portion of this business, and that portion generates some amount of earnings that I have a claim to as a shareholder. And so when we look at the direction of earnings, when earnings take a turn the way they did last year, it means you should be willing to pay a little bit less for stocks. But the expectation as you look to 2021 full year, as you look to 2022 full year, is that we see double-digit earnings growth for the S&P 500. Again, that only happens because of how significantly earnings fell off last year. And so that's an absolutely valid criticism of, where do we see things headed? But I want to stress that, we absolutely see earnings recovering. We absolutely see that the direction ahead is for earnings to come back in a significant way. And for stock investors last year, early this year, what they're looking at is not where we were. What they're looking at is, okay, the expectation for the road ahead as we roll out vaccines, as we've come up with better treatments for this pandemic, the road ahead actually looks considerably better. The road ahead actually gets us back at some point in time in the next year to 18 months, gets us back to where we were and then some. And so, I want to stress again, the economy is not the stock market. And most importantly, even for the stock market, we're not looking at what happened. We're looking at the road ahead.
Kyle, question here for you is an article this morning. CBO says that we're going to be great. We're going to be doing pretty good next year, even without the stimulus money. So the question is when you look at what you project for 21 and 22, is that based on a $2 trillion stimulus money coming in or not?
Yeah, so these are analyst forecasts that depend entirely upon the information that's already available, not necessarily on what the expectations are for stimulus. And so this does not necessarily count on stimulus. The challenge, and this is a significant challenge as we look ahead, is what happens with that stimulus money. And what we've seen is that while that money has made its way into the system, it isn't accelerating through the system. And so what we care about is velocity when we talk about money that makes its way into the system. And this leads into the question of inflation that I'm sure is on so many people's minds is, if we're pumping money into the system, we're raising the money supply, isn't inflation sure to follow? And I think the reality is that is a likely outcome, but only if the money makes its way through. And as I mentioned earlier, the bottom 90% of earners spend 99% of their after-tax income. You give them $1, it's going to go back to the system. The top 10%, they'll only spend 2/3 of what they make. And so it depends on where the money ends up. What we saw last year was that money pooled on balance sheets. Households didn't spend the way that they used to, in part because there wasn't anything to spend it on that they wanted to spend it on, but also in part because they weren't confident about what the future looked like. And so, yes, the expectation is that there will be stimulus that will help those earnings numbers, that will help the economy. I don't know that it's fully reflected in what those expectations look like. And I think, the meaningful challenge for stock investors is that as we look to the road ahead, there are two significant issues. One is valuations, right? What are we willing to pay for stocks? And what we're willing to pay is based on our forecasts. If we're wrong about our forecasts, if we're wrong about the direction that we're headed, either because we counted on 1.9 trillion and it was only 600 million, or because this pandemic carries on for longer than we expected, that doesn't paint as rosy of a picture. On the other side of that, though, when we initially talked about vaccinations, we thought maybe by the end of the year. Well, the Biden administration has said that they expect to be able to vaccinate all those eligible by the end of summer. It's an ambitious goal. I can't claim to know whether or not we're going to get there. I can claim to know that if that's the case, you likely have more people confident about going out to eat. You likely have more people confident about traveling, even if it's smaller travel than what they're used to doing. And that means that a lot of the structural issues that we saw in employment, again, 40% of unemployment still is from travel and leisure. A lot of those structural issues become less of a problem as the year goes on. That's more money that can be spent. It means more velocity then of that money making its way through the system. We haven't seen it. This isn't the first time we've had large amounts of stimulus. You can go back to the financial crisis and see, a huge influx of cash into the system. And yet, despite the fact that we all called for inflation, or many called for inflation, inflation really hasn't reared its ugly head. Now, I want to stress that's not entirely true. You've seen inflation at the grocery store. The price of meat's gone up. The price of poultry's gone up. Those are supply side issues, certainly. When you've got to shut down a production facility, you're going to have those issues. But I think, as we look at the road ahead, inflation is not the immediate concern. The immediate concern is keeping the economy on solid foundation. Want to stress maybe one more point here, and we can certainly go off in 1,000 directions on inflation. I've got plenty to say there, but as we look at valuations, if we're even close to what we think could happen for earnings, if we're even close to what we think could happen for the markets broadly, what matters is two things, right? What are we willing to pay for those? And what we're willing to pay is a function of what our alternatives are. And so you can take a price that you're willing to pay for stocks and the earnings that you expect to get from it. And right now, we're willing to pay about $22 for $1 of earnings in the S&P 500. You call that a price to earnings ratio. Typically, on average, historically, that's somewhere in the 15 to 16 times range, or $15 to $16 for every dollar of earnings that you expect. But again, right now, we're willing to pay a little more for that. One of the reasons for that is that the alternatives to stocks just aren't that great. The yield on the 10-year treasury right now, as an example, a little better than 1%. And so if you take the reciprocal, and this is, maybe a step beyond kind of the intro level finance course here, but if instead of saying, what am I willing to pay for $1 of earnings, you say, for $1 that I invest, how much earnings am I expecting? Right now, every dollar you invest in the S&P 500, we expect 3 or 4 cents of earnings. Every dollar that you invest in a 10-year treasury bond, you're expecting essentially a penny, a little more than a penny in interest from that bond. And so stocks and bonds are not the same thing. Certainly stocks are more volatile. But the reality is that 3 is a bigger number than 1. And if you're talking about, what's the bigger opportunity right now, if you're willing to put up with the volatility, there's more opportunity, there's more potential return in stocks than there are in bonds. Now, there's 1,000 ways to go from there. There's 1,000 reasons why you need all kinds of things in a portfolio. If we're talking about, what's the right allocation for me, those aren't conversations you have in a setting like this, other than to say, it isn't as simple as saying, 3 is a bigger number than 1. And so, I want to stress the stock market is not the economy. I want to stress that there's a lot of reasons to be optimistic about the direction we go from here. But at the same time, we've got stretched valuations for stocks. At the same time, there are a lot of hurdles that we still need to overcome, whether it's vaccination, whether it's how we navigate further stimulus, whether it's dealing with the real issues of equality that are holding back many investors or many potential investors in this country. And that says nothing about some of the fairness and trust issues that have started to pop up with some of the, I think, pretty interesting trading that's happened in the last week or two, but maybe not reflective of, the broader fundamental picture.
Well, thanks, Kyle. I wonder whether or not your 10-year-old is got some GameStop market, it's GameStop options for you at night when you go to bed and he gets into your computer?
I think my 10-year-old is more interested in visiting GameStop than in purchasing GameStop. But yeah, it has been an interesting story to watch develop, and can't stress enough that I think there's a very big difference when we talk about something like that versus when we talk about what's actually happening in the world. That is completely separate, completely different than, the actual fundamentals of the economy or markets. It absolutely is a thing in and of itself.
Well, I'm sure it keeps your brain going. So we're going to move to Tony now from First Business Bank. And Kurt's put up a little bio for Tony. And Tony, appreciate the coat and tie, because the rest of us are all like pretty laid back. Dennis in Tucson and Kurt's up at skiing up north. But
I dress like this every day of every hour of the day.
That's not how you talked to us last week. Okay.
Right.
So Tony, you may have some things that overlap, but I think that everything you tell us, we're all interested in knowing, because I assume that probably about 3/4 of the people on this are annuitants of some sort. So take it away.
Yeah, so I guess what I would like, we don't use Zoom a lot with First Business Bank. So if I can ask Kurt to maybe help me out and show a slide.
I can do that for you.
Great.
And it's just that PDF, right?
Yeah. And I'd like just kind of give a little summary of, what we do at First Business. Kyle did a great summary of things that they're looking at, and a great summary of what's been going on.
Is that screen behind you, Tony, something that you actually follow every day? Is that part of your work?
Yeah. So I'm on the investment team, so we try to keep it, on top of as many things as we can. This is just a chart of what's going on in the markets today. I focus a lot on sector analysis. I focus a lot on high level S&P 500.
How you make sense of all of that? Gosh, it looks like a weatherman. Like a weatherman. You're showing temperatures.
There's a lot of noise, and you just gotta kind of shuffle through all that stuff. But
okay.
Yeah, Kurt, if you can please maybe go to the next slide.
Sure.
Quick snapshot. At First Business, we manage about $2.2 billion. We're asset allocators across the board. We use high-level ETF product, and we invest in international as well. Next slide. I'll just kind of go through this real quickly. From a relationship standpoint, we do financial planning, investment management, which is the team I'm on. We're trustees for estates, and we have private banking. Slide.
Yeah, that's your team.
Yeah, there's 9 people on our team, and I'm one of 5 that is a voting member for decisions on what we're going to do within the asset allocation strategy. I've been at First Business for now going on 6 years. From an investment standpoint, a lot of the stuff Kyle covered. So we take a weight of the evidence approach, looking at the macro level fundamentals, sentiment, and technical, all things that can really drive equity prices, valuations. Of course, under macro, we're going to look at GDP growth, consumer confidence, fundamentals. Kyle mentioned this, PE ratios, revenue growth, dividend yield. From a technical aspect, I have my chartered market technician certification, so I focus a lot of this on the team. Technicals, where you look at moving averages, how markets are trading, how many stocks are participating, where the relative strength in the market is. From a sentiment perspective, we look at investor and advisor surveys, speculator positioning. A lot of these things, these parts focus a little bit on the shorter term parts of the market, but what you have to be careful is and pay attention to if it's going to bleed into like a longer term trend. Next page. Thank you. As Kyle mentioned, this is one of the things we look at in terms of valuations. Kyle mentioned 15, 16 times long-term PE ratio. Currently, we're trading 22 times. And as Kyle mentioned before, getting a little pricey. Obviously, with the 10-year trading little over 1%, there's the what else can we buy kind of mentality that's going on. So in markets that are trading 22, 23 times, it's important to see what the alternative is. And right now, the alternative is fixed income at lower yielding rates.
What was the term you used last week, Tony? What we talked about?
Tina, there is no alternative.
I like that term.
And Tony, that's where the large institutions have to go because they've got to put their money somewhere.
Yeah, I mean, so if the dividend yield is low on treasury or fixed income, a lot of times what happens is an investor will look at equities, and the most conservative part of the equity market to come in is going to be in utilities and staples. A staple stock would be something like a Johnson & Johnson, Procter & Gamble, that pays a nice dividend yield. And because of the products those companies sell, over a 10-year period, people are comfortable that the company's not going to go out of business and the products are going to still be in demand. So if you can get a 2% dividend yield for, let's say, on a staple or a utility, investors will say, well, I can get 1.1% on a 10-year treasury, or I can sit in utilities or staples for 10 years and at least give it the dividend. And then if the economy grows over 10 years and the products are still in demand, I'll be better off with potential price appreciation.
Okay, thank you.
This is in terms of technicals, we pay attention to broad markets, S&P 500, NASDAQ. We're looking for trends, many over long periods of time. And this is for investors that can kind of ignore the short-term volatility in the market. Typically, when you look at a lot of price charts and major indexes, their charts are lower left, upper right, and that's a good thing because it's increasing prices over time. Of course, we're going to run into bouts of corrections, as we all know what happened last year. But from an investment standpoint and positioning portfolios, we want to make sure that the wind is behind our sails, because it's very tough to go against the wind and against the trend to have. Next page.
You all set? Okay.
This is a sentiment indicator. So a lot of times, and Warren Buffett quoted, you want to buy when there's fear in the streets, and you got to be careful when people are getting greedy. So this sentiment indicator that we kind of look at has 18 indicators behind it: put call ratios, bull bear surveys, the VIX. It's plotted in a chart, and we're looking for excess optimism and excess pessimism, because those can be major turning points in the market.
And the top one means there's optimism right now?
Well, the top chart is actually the S&P. So you kind of look at the bottom
gotcha.
one and you look for excess pessimism,
I got you.
for instance, and those usually align to market bottoms. Again, when no one wants to talk about stocks, that's really the time to maybe look at your allocation, rebalance if equities are underweight your longer term goals. And then, of course, at times like now, we're at new highs and we get into excess optimism. That's when you really want to, put the flag up and say, well, let's analyze and see what's really going on. And you'll see things, and Kyle mentioned it too, some of the trading that's been going on and with GameStop and some of these stocks, that's total speculation. So you got to make sure that when you see areas like that showing up, that you want to make sure that you're not in areas that you're really exposed to high beta names, things like that. So it's a way to say, is this really going to spread to the market? So let's really pay attention to it. So luckily, over the last few days, the market's rallied into all this, with all the speculation going on in some of these names. That's not a major part of the market. So for us, we're comfortable that it's not at this point going to really bleed over into other areas of the market.
So those day trader question here for those day traders then are really, if they're, I would say, amateurs, really risking when to be in and when to be out, and what comes of that. That's a real risk if they're not really knowledgeable.
Yeah. somebody came up with an idea to squeeze the hedge funds. And one way to do that is to get everybody on one side and buy the trade. Now the question is, what's their signal to get out? I mean, there's going to be a lot of investors that are going to get hurt in this. And today I think it was down 50%. GameStop hit 480 not too long ago, and I think it was like 100 and something today. I didn't check the price, but yeah, there's going to be a lot of investors that are going to get hurt in that. So there's.
Are you finished with your slides, Tony? Because then I'll just drop these.
Yeah, you can drop that.
Okay, cool. Because I'd love to have both you guys chatting. All right, cool. Sorry, I didn't mean to interrupt you.
Oh, no, not at all.
So first question we got going on here. One is from, I think probably based on what you had said, Kyle, about velocity. In one of our earlier discussions with modern monetary policy and stuff, we talked about velocity, saying it goes through 7 times. Dollar passes through 7 times. But savings are growing. So where exactly are people keeping this money if they're not passing it through?
Yeah, that's such a good question. So 3 challenges to this. Number one, we need to define these people, right? So when we say where are people keeping money, there's a huge divide between the people who are saving money and the people who are not. And that's a big part of the problem of why the money isn't being spent. But more importantly, to get then specifically to the question, where is this money being kept? All over the place. So when you look at, for example, cash on the sidelines, one of the big things that we look at is dry powder. When you talk about investing, a thing that you want to be able to do is take advantage of, Tony pointed out that market sentiment indicator. When things get very pessimistic, you tend to be optimistic about the direction the markets are headed. The saying is that stock markets climb a wall of worry. And so if everybody is in agreement that things are going to fall apart, you're pretty confident that the vast majority of selling has taken place. You want dry powder. And so what we've seen is that individual investors, institutional investors have had meaningful amounts of dry powder for much of last year, certainly coming into this year. And so dry powder is cash, it's money markets, it's CDs at the bank. But beyond that, we've also seen, investors and people who had never invested before moving into new ways of investing, whether it's these technical trades that we've seen, whether it's utilizing new vehicles that hadn't been around before. And so it isn't as simple as saying cash is sitting in one place or the other. Part of the answer is, okay, who has the cash? The other part of the answer is we've seen it go to lots of different places. Most of it has built up as cash, but also we've seen support for stocks. We've seen support for any number of other instruments.
So there's a question for both of you, to 2 or 3 all around interest rates. So one is what is the role of interest rates in this? When either of you talk about what negative interest rates are, like what's happening in Japan and how that even works, if it's possible, and is the Fed basically, as I said at the beginning, is the Fed out of ammunition? So there's about 3 questions rolled in there. Whichever one of you want to take it.
Sure, yeah, I can start. So yeah, rates play an important role. Rates are going to be one of the first things that you see. It's going to show inflation peaking coming up in the market. So at 1.1% again, as we mentioned before, there's no alternative, and the Fed is really controlling the front end of the curve. And they said that they're going to stay in this position for a little while now. So with that said, there's very little alternative to go in that, and you can hold these higher prices. At some point, of course, inflation is going to show up, and you can kind of see it if you look at some of the commodity charts, corn and wheat and gas and heating oil. When you combine those things together, the index for commodities it's in an uptrend now. So there's going to be a point in time where the bond market's going to say, well, we need to get ahead of this. The Fed is going to be forced to move. And at that point, probably in the 1.50, 1.5, 1.75%, with Treasury, people will start to reevaluate and possibly move some monies out of equity. So that will be for us a signal that, you know, maybe the markets might stall out, and maybe at that point valuations will come into play. Kyle, if you have anything to add to that.
You know, maybe just to stress that interest rates tend to be good economic forecasters, right? That if you look over extended periods of time, interest rates should reflect what our expectations for the future are. And the reason for that is if you buy, for example, that 10-year treasury, your expected return over the 10 years that you hold that bond is whatever interest rate you got when you bought it. That interest rate doesn't change. And so if you don't think that inflation is going to be a problem, you're willing to accept 1.1% on a 10-year treasury because the real rate of return that you get isn't going to be impacted by inflation taking off. But the other part of that question, you know, is the Fed out of ammunition? You know, what tools are available as far as negative rates and those kinds of things? You know, we've seen negative rates in parts of the world. We even saw corporate bonds issued with negative rates, which would have been unheard of 10 years ago. But the reality is that that's one tool that global central banks had to encourage money to leave the banks, to encourage people to spend, as opposed to just hoarding it on finance sheets. And what we saw in Japan as one great example is rather than buy yen-denominated bonds, you had individual Japanese consumers buying safes. You had a run on household safes because it was a better investment to buy a safe to put your money in than it was to pay, you know, the Japanese central bank to take that money from you. And so, you know, there are impacts of those negative rate policies. The Fed has largely said that's not something they see here, that they see needing to do here, because they have many more tools available to them. We saw that with quantitative and qualitative easing. Not only can we direct money into the system beyond simply the rate levers that we have, we can also change where that money goes. And so we, as a country, have created credit lending facilities that backstop certain areas of the market. We've created, you know, via fiscal stimulus support for markets. And so I think, you know, the negative rate question, while it isn't impossible to do, it's unpalatable for a variety of reasons. And more importantly, it's something the Fed has said is not likely to occur. But again, all of this comes down to expectations for economic growth. We've been stuck in an environment in which economic growth, really since the financial crisis, has been somewhat stagnant. And so as you look at the road ahead, what changes to make economic growth pick up? The big one for me is that this pandemic has forced productivity growth upon business, right? It was unheard of before to be able to do a snow day for schools from home. Even 20 years ago, you never would have heard of it. And now, you know, within the last 5 years, we started talking about maybe snow days are the thing of the past. Well, I can tell you that last week, Tuesday, when we had a snowstorm, my school district was out. My kids were still learning from home. In the past, if that had been the case, I would have had to take a day off work to stay here and go play out in the snow with them. Instead, because I'm also working from home, I get to keep on working. They get to keep on doing their school. And so we have, you know, some productivity gains that were forced upon us by this pandemic that I think absolutely lead to some meaningful economic gain once we're able to return to whatever the new normal is. And I think new normal is this term that gets thrown out without really ever defining it. But once we return to whatever this new normal is, it's not like we suddenly forget how to do all the things we learned how to do. These productivity gains are here to stay. And so as you talk about economic growth, as you talk about kind of expectations for rates, you know, Tony, you mentioned when you start to see rates tick up, it looks like a more attractive alternative. There is a future for that, but we've got a ways to go, I think, before that's what's being, you know, expected by the market. And, you know, that's obvious in where the 10-year is. It's obvious when you look at, you know, other areas of the market that price in inflation. We're just not pricing in inflation at a level that's anything beyond what the Fed thinks is reasonable.
Interesting, the productivity thing. I know we talked before in some of these about the leapfrogging. that's happened because of this. Kurt's been a big advocate about that, about things that you would never seen, but now we see maybe in 10 years. And as of course, as your former place, Kurt, I mean, is anybody even in your building?
Not right now. Once a week.
And
Once
that's
a week. We'll abandon. That's why commercial real estate has me a little concerned.
and that's 75 people not working in your office anymore.
Correct.
And they're working from all over the country, and you're
And
still
actually, at this point, we have 2 guys outside the country, which creates a new set of challenges.
yeah. So that kind of thing is incredible to look at with it.
I actually got a couple of questions. You guys, both you guys are on. I'd like to get your take on Bitcoin and our cryptocurrency more broadly, and what's going on there. And then the second one is catalyst, right? Is the GameStop stuff could be a catalyst for a correction. Could be. It doesn't appear to be. So
Yeah, I mean, I could start with Bitcoin for sure. 2 significant challenges. Number one, there is no trust in a market that is as decentralized as Bitcoin is. And one argument is that you trust it more because it can't be manipulated. But the other side of that is that, well, no, we've seen it. We saw it with GameStop. We've seen it with people piling in. The other is that the actual process of mining Bitcoins, which again, this is going to sound absolutely absurd for those that aren't versed in it, but the actual process of mining Bitcoin takes an incredible amount of processing power. It takes an incredible amount of energy. And so as you think about the implications of doing that, you don't simply create these out of thin air. There's processing on computers that has to be done to do that. And so you have entire server farms working on that. You have entire teams that are dedicated to this process. And so it isn't entirely this fanciful thing. What I like about Bitcoin, as much as I beat on it for, I think the economic concept is the greater fool, right? It's only worth what the next person's willing to pay. And you better hope that you're not the greatest fool. You better hope there's somebody else that's willing to pay more than what you were willing to pay for it. What I like about Bitcoin, though, is the foundational structure of it. The idea of blockchain, which is what Bitcoin is built on, is the future of financial services. When you look at what people like payment processors are pouring money into, Visa, MasterCard, when you look at what some of the biggest banks are pouring money into, it is absolutely blockchain technology. And that allows you essentially on a real-time basis to understand what transactions are happening, where money is moving, and to verify it with technological proof that this is who the money was supposed to go to, this is where it came from. That technology is here to stay. I don't know that Bitcoin or some other digital currency necessarily is the viable piece. Maybe it is and maybe it isn't. I'm more interested in the blockchain technology that's been created from it.
Mm-hmm. And Tony, your thoughts?
Yeah, so Bitcoin, it's an interesting concept. We like to stay, for lack of a better word, in our lane and what we're good at. We understand what's going on with disruptive technology and cryptocurrencies, but for us, we focus more on the asset allocations and a little bit of alternative investments, but mostly the mainstream investments. I think that's where we have our most strength. For us, with kind of the speculation that's going on with new investors, it's a great thing to get new investors into the market and understand. So for us, with some of the things that's going on, we just want to make sure that those things don't bleed into the overall market and you start getting more and more speculation, because we all know what happened in the financial crisis and the tech bubble. So we want to really keep our eye what can kind of spread into the market from speculative areas of the market. So with GameStop, again, I think a lot of people are going to get hurt. I hope not too bad, but I hope they stay with investments, because it's good to have that education with everyone participating in the market. So.
But does that answer Kurt's question about basically the gamifying investing going on? And I mean, getting new people in, but is that your point, Kurt, that is this a catalyst for other kind of change?
Which might cause a correction of some sort. Yeah,
Yeah.
that was, and you're right. Great gamifying. I don't even know what percentage sort of that retail investor is, right? That's using third party.
Well, I mean, a retail investor is a small flow of actually driving stock prices.
Mm-hmm.
And yeah, it's not great that it's being treated that way as a gamification of equity investing. That's what we don't want. We want to have fundamental reasons to buy good companies, trust in the market, and I think we're losing a little bit of that with some of that speculation that's going on. And who knows what happens with Robinhood? They had to get a bunch of capital in because they couldn't they have to make sure they can cover all these trades. So it's going to be interesting how this all plays out.
Well, the spillover is really interesting because, of course, now there's looking at whether or not sort of the radical right, the people who are against government, people who are some of the insurrectionists who are at the Capitol are also jumping on to this whole effort, this whole part of this, and again, exposing some folks who are not very experienced with it and might be losing a lot more than what they think, just like they thought you could go into the Capitol because I stayed behind the little red rope. I mean, it's interesting to see how these things overlap by, but what with the thinking of folks out there that this is somehow anti-government, we're going against the big guy, it's all this stuff. So you got this merger, this in my mind, sort of this odd merger of stuff going on. Kyle, I interrupted you.
Well, no, I was just going to, investable markets are founded on trust. And if you can't have faith and trust in those markets, it becomes difficult to continue to invest. And so, Tony and I can sit here and say, this has nothing to do with fundamentals. This has nothing to do with what we do. This has nothing to do with what most investors do. But the more that it happens, the more people are going to question, is this something that should be happening? And how do we control it? And you're seeing those questions already with lawsuits, with comments from the SEC. There are regulatory bodies out there whose job it is to try to navigate these issues. So far, they've been fairly quiet on what rules have been broken, if any. So far, they've been fairly quiet on how in the future they might try to regulate this. But I think the other side of that is to understand that there are going to be people that are burned by this, but that's always been the case. You go back to corporate raiders in the 80s, you go back to the tech bubble in the late 90s and early 2000s. There were people who piled into trades that they didn't understand, who were subsequently burned by it. And we're still, as somebody who talks to clients every day, we're still hearing those stories about how I don't trust this particular area of the market. I don't trust this particular player in the market because I got burned by them 20 or 30 years ago. And so the ramifications of this are long felt. I don't think we're going to say, 6 months from now, okay, we solved that problem and now it's over. We'll be dealing with this for a long time. And I think, for our industry, trust has always been the key. It's why, again, you need those regulations, but also you need people that want to act in the right way. And so when you get people who are brand new to the industry, who have never invested before, who essentially who have been encouraged by, that term gamification, who have been encouraged to participate in something because they think it's a game that can make them a lot of money. You're also going to have a lot of people who completely misunderstand what this is really all about, right? That investing isn't about making a buck overnight. Investing is about what's my objective, what's my goal, and how can I create a plan that gets me from what I have today, adding along the way while I can, to where I want to be 5, 10, 20 years from now. Yeah, you can make a lot of money overnight if you do things like buy GameStop at the right time. But if you can make that much money overnight, you can lose it just as quickly. And I think we're seeing that. I think we're going to feel the ramifications for a long time.
There's a question here about commodities. What do you see 2 to 5 years out? What are the commodities to be thinking about? Tony, you want to start?
Yeah, excellent question. I think some of the opportunities are in terms of commodities could be in some of the more depressed areas of the market. So like in the energy area, that would be dependent upon how quickly we can get past the pandemic and get the economy open back to normal. Because there's plenty of pent up demand. People want to get out and do things. People want to travel. So in terms of just a commodity play, one thing that a person could look at is just the energy area.
Kyle?
Just want to stress with commodities that commodity prices are very closely tied to economic growth. And so to the extent that inflation isn't an issue, to the extent that an overheating economy isn't an issue, you're not going to see commodity prices likely take a huge pop. Now, when we use a term like commodities, we're using a very broad term to define lots of little things: hard goods, soft goods, all kinds of pieces that make up that commodities basket. Tony alluded to this earlier, but we've seen price inflation in certain soft good commodities. As an example, the pork belly or the frozen orange juice concentrate futures. Those are the things that people don't always think of when they're talking about commodities, but there absolutely will be winners and losers from area to area of the commodities market, even before we see broad commodity price movements. I think that the bigger concern is that we just don't see a great opportunity there yet. And there's so many opportunities in other places that you have to talk about opportunity cost. What are you missing out on while you're waiting for commodities to run higher? And then even as commodities do run higher, what other things might participate? And so, commodities, broadly speaking, aren't a big part of what we do, because I'd much rather invest in other areas that can get good returns now, but can also get good returns in environments that support commodities. And so, you talk about a high inflation environment being a positive thing for commodities. What else does well in a high inflation environment? Typically that's stocks, right? If you're talking about high inflation, what does that mean? It means that prices are going up. What are the prices going up on? The things that American businesses are selling. And if the prices are going up, it means more money is coming into those businesses, which means earnings are going up. And it all gets back to what actually matters for investors, and specifically stock investors. Two things: earnings and interest rates. Yeah, the interest rate piece looks a little bit worse when commodity prices and inflation overall goes higher, but you're also seeing the earnings piece increase pretty drastically. And so commodities can be a great way to diversify some risk. They can be a great way to participate in areas of the market that look different than everything else. But if you're betting on commodity price inflation, you're doing it at the cost of other areas that you could invest. And also those other areas are probably going to participate to a similar extent when commodities finally do become the next big thing.
Yeah, and it's an excellent point. And we don't as well invest specifically in commodities, but we'll look for is if there is going to be a general change in oil, for instance, and oil was trading 25 a barrel back in April. Now it's trading in the 50s, low 50s. So you get a move like that, people start to get interested in certain areas of the market. And for us, that would be like energy names. You got Exxon, Chevron, anybody that's participating in that has a commodity, a business of oil. And then if you have more demand in lumber, more demand in other things that are cyclical in the economy, then what's going to participate is probably the rails. So now you have industrials that are going to participate in that area of the market. So what you'll find in terms of value versus growth portfolio is those cyclical areas of the market show up and have heavier weights in value indices than they do in growth indices. So if you can see a change in commodities, and that's what we're looking for. If it's going to stick and we're going to move forward from here, then you have to really consider start shifting to those value parts of the market.
So there's a question about whether you're seeing any real concern on the tech and the social media because of government threat to break them up and do the old Standard Oil thing. And as Kurt points out, I think you pointed out before, Kurt, that if we do break up those big markets, those big tech things like Microsoft or Google, there's no guarantee that we will continue to have any kind of dominance if you break those things up.
They absolutely are monopolies. They are also U.S. monopolies. So you break them up, and there's a good chance that somebody from another area of the world is going to take over dominance in those spaces.
But are you seeing any of that?
I'd like to hear what your guys' thoughts are.
Yeah, what are you thinking on that, you two?
You know, I mentioned earlier 38% of the market of the S&P 500, so broad US market, is technology and communication services. And that encompasses the Facebooks of the world, the Googles of the world, you know, a few other big name players. But, you know, your point about if you tear something down here, someone somewhere else is going to build it up. We've already seen it in China. WeChat, TikTok, all of those services that have tried to compete in some form or fashion with our own social media. Now, you know, we've tried different things to regulate them out of our markets. We've tried different things to try to make sure that the U.S. can participate in that. But I don't think that's the primary concern. But the more important piece here is that, you know, as an investor, if you're invested in one of those businesses, what are you left with when the government breaks them up, right? So, you know, you go back to some of the old cases of monopolies being broken up. You know, the old Ma Bell AT&T is the prime example of a company that was forced into a million different pieces. Investors wound up with all those different pieces. And so you're going to have a lot of really interesting businesses. You know, you've got, you know, take Facebook as an example. Maybe you've got the social media piece of it, but maybe there's an ad piece of it, and maybe there's an Instagram piece of it, and maybe there's all these pieces that shareholders wind up with, because as you break them up, you don't just tell the shareholders, all right, you don't own this anymore. You tell them, okay, now you've got 4 or 5 different companies instead of one, and there's going to be a lot of winners and losers there. And so, broadly speaking, it may not impact investors as much as it impacts the way that we think about how we do business here in this country. I think when you talk about a capitalistic system or capitalism as we know it, you know, we have always felt that there's a point in which you're too big, and that's never been all that controversial. But the question is, how big is too big, right? And we saw it with the banks in the financial crisis. All of a sudden, the government had to step in and back them because some of them were too big to fail. And so if we're talking about breaking up what is some of the foundational pieces of investment, yeah, okay, we've got to have a conversation about, are they all of a sudden too big? What's going to come in and fill the void? And what are the implications of that? And I think, you know, there isn't a good answer there. We clearly have an issue with the flow of information in our country. We clearly have an issue with who controls the content, how they control it, and what they do with it. I don't think there's a question there. I think the question is, what do you do about it? And there isn't a good answer. And that's not the investment, you know, part of me talking. That's the, okay, we've got some real structural issues here that we've got to address. I don't know that we have to focus as much on what the investment implication of that is as we need to focus on, okay, what's the political, economic, socioeconomic implications of how we deal with this issue.
Tony, do you have an opinion?
Yeah, I mean, it's going to be interesting how this plays out and how the politicians, if they actually go forward and start bringing executives again to speak in front of them and explain what their process is and how they allow free information to flow through the organization. It's, you know, we've seen this before, and are they actually going to do anything about it is, I guess, my question. That's the big unknown. But yeah, I think it's certainly something that needs to be addressed. For us, it's not a major piece. You know, Facebook, for instance, is about 2% of the S&P 500. Google's about 3.5%. If they broke those companies up, yeah, if you hold the stock individually, that might hurt you a little bit, depending on your exposure. But from an overall perspective, in terms of the S&P, it shouldn't have that major of an impact on that part of the market. So
we got a question about all the people who are not in the stock market, all the low-income folks who don't have any pension or company, company money to help them. What are the options for them, both for saving and moving? What are some of the things that they could do with their money if they're not in the stock market, they don't have that kind of pension plan going on.
I mean, just to start off that conversation, first and foremost, our industry has a responsibility to those individuals, just like we have a responsibility to the, extremely high net worth individuals. And what we've seen is that the technological innovations that have happened have made financial advice more readily available to those people just starting out or thinking about starting out. And so whether that's, the early days of, TV, radio, or even internet financial advice, or whether that's what we've seen now with, companies like Mint or NerdWallet, coming into existence and talking about, okay, here's some ways that you can think about saving. So, from a very practical standpoint, it's about getting those people the right tools on how to start. The bigger issue is getting them the resources to be able to do it. And some of that is absolutely an issue of equality and fairness in this country. Some of that is absolutely an issue of, politically, how do we provide for those people that don't have the resources necessary to think about tomorrow when they're stuck spending, again, and this is one of my favorite things to go back to. The bottom 90% of earners in our country spend 99 cents of every after-tax dollar they earn. That doesn't leave a lot of money to save for the future. You look at that data a couple of years ago, they were spending essentially more than every after-tax dollar they earned. It's gotten a little better because of the pandemic. It's gotten a little better because increased unemployment checks have actually boosted a lot of income for people. But again, there are real issues of equality and fairness that have put people in a place where they can't save for the future. So we talk about cash piling up on balance sheets, and we talk about velocity of money. All of these issues are intertwined, right? If you can get the money through the system faster, you can get it into the hands of the people who are going to spend it. That also means that those people have money to save. There isn't a finance or investment answer to that question. And so, we can jump into the political conversation and have a million different opinions about how you're supposed to deal with that problem. I think from what is our responsibility in our industry? Our responsibility is to make sure that those people have the tools and resources available to them to do it the right way. And so, from a who am I as an American perspective, I've got a very different responsibility. But from within our industry, I think we've done a pretty good job of saying, we used to care if you had a balance of 500,000 or more, or $1 million or more, then you could be our client. And you'll hear those advertisements on TV, right? Hey, if you've got 500,000 in savings, give me a call. Yeah, okay, that's a great way, from my perspective, to screen out those people that are going to make me a lot of money. But it's a terrible way to give advice to the people who actually need it. And so, those resources are there. We need to continue to push that, people take advantage of them. And then more broadly, need to address the other part of that question.
Tony, you want to add anything to that?
Yeah, I mean, I totally agree. I think it all stems from education. I kind of think back in my early days, just growing up, and it was about saving, working hard, learning. I think if we could, and when I was in grade school, high school, middle school, I just feel that we don't have the basics of finance, checking accounts, savings accounts, budgeting. I think that's a very important thing to have, and that just will then lead to a lot of equality. I live in Waunakee, Wisconsin, and my kids are in 6th and 8th grade, and up to this point, they have not had any classes that would teach any kind of basic finance. So I take that upon myself, because I've been doing this for so many years, to teach them the things. And I think that's where it's really going to start. And whatever the industry can do to share that information, it's great for society. I mean, everybody in these days has a cell phone in their hand practically. It's just that we have to somehow direct them to important things and away from TikTok and watching videos and those kind of things and seeing what their friends are doing on YouTube versus some basic financial fundamentals.
One of the speakers we had last year with this class, Dennis, you might remember, is Robert Wynn, African-American. He's on the American Player APT board and a longtime advocate and several programs to not just help young African-American kids find jobs. He wants to talk about wealth, helping them learn about wealth, because it's not getting a job is important, is what he said, but he said much more important is teaching you about wealth. So he has stock market clubs that he did this summer with he paired up with a group down in Florida to do that. And there's a lot of classes and things he's doing to, again, try to help think about creating wealth, not just getting a jobs there, but that was his broader point. Which brings up a question somebody has, is that what if you did do the 0.1% on every stock market transaction? Would that also change any of the speculation? Would that be useful? Would it hurt you two guys' business at all if there was a tax like that? How might it be used?
I mean, would it hurt our business? No, we're not a trading shop. We're not a firm that says, you've got to buy and sell every day. You've got to do this, you've got to do that in order to make money. We absolutely believe that what we're holding is the right thing to hold for the long term. And so it's not going to impact our investors all that much. I think it does curb maybe some of the speculation. It could help in that way. But you've got to remember that these are folks that essentially all of a sudden have been given free rein, that for the longest time it cost a meaningful amount of money to trade stocks. And it wasn't a tax. This is what it costs to do business. You wanted to open an account with one of the big wirehouses or one of the big brokerage firms. You want to call up and buy or sell a stock, it's going to cost you $50 or $100 every time you want to place that transaction. And that excluded a lot of people from, I think, frequent transactions. With the advent of Robinhood and other apps like that, you've taken away some of that cost. And so adding it back in the form of a transaction cost could help to curb some of that. The challenge is it may also keep some people out of the markets. It may also dissuade some people from, okay, well, I was going to do this, but I already have some pretty poor opinions about what happens with my tax revenue, and I don't want to give them more money, so I'm just going to put it here instead. Now, maybe that's the fringe, and I certainly think it's an idea we need to explore, not just because we have significant amounts of debt in this country that we need to figure out how to pay for, but also because, as you say, maybe that is the thing that helps curb some of that speculation. But again, I think we need to look at that closely and understand that it wouldn't be new to have those costs, that we've gone from an environment in which they existed to an environment in which, for the most part, they don't. What would the impact of bringing those back be?
Yeah, I agree. It wouldn't affect our business. We're not trading all the time. We'll make adjustments to the portfolio based on the weight of the evidence. Certainly, I think, if you will, a tax on some trading would help because, as Kyle mentioned, we're down to 0 commissions. So now what behind the scenes, there's no free lunch, right? So behind the scenes, there's order flow. So these platforms direct their trades to certain traders, and for that, they'll get a piece of the order flow in a rebate, if you will. So nothing's free. To slow down some of the speculation, yeah, I think it would make sense to have a tax, but I think it would hurt at the same time the retail investor more. But I think it's in the best interest of the retail investor to not speculate a lot, look for the long term. And if you have a little bit larger commission up front over the long term, it's not that big of a piece of your return. So.
And you were using that term retail investor. You guys might want to just explain what that is.
Yeah, for us, it's, typically if a stock is trading 10,000 shares in blocks like that, that'll be an institution coming in. So like us, we would be an institution. If we made an adjustment in our portfolio, moving from large growth to large value, that could be a $25 million trade. So we're coming in as a big block trader versus 100 shares here, 100 shares there, 1,000 shares. So that is kind of the big difference between a retail investor, if you will, and an institutional investor, pension plans, things like that.
Yeah, Tony's right. It's really those two distinctions. If you're not an institution, you're a retail investor. And so the institutional investors are the biggest players in the market, the banks, the hedge funds, the ones that can trade in those large quantities. It's a nebulous definition. It's not a hard and fast line. But I think, for the most part, Tony hit the nail on the head there.
We've got a question here about China. Everything from gathering data on our private citizens to, what can they do to our market, and how fast they could do that. I don't have any more specific question on that, but how do you keep an eye on what China's doing?
I mean, there are always going to be adverse actors, people that are trying to act against our best interest. You've heard for years that China owns a large portion of U.S. debt. You've heard for years that we have significant trading deficits with China. And that's something that the Trump administration had tried to address in a number of different ways. And I think, when you talk about, for example, China collecting data, let's not forget that the U.S. collects as much, if not more, data on our own consumers. A great example, you look at a company like Tesla, right? And Tesla had a great year last year, but why is Tesla as big as it is? It's as big as it is not because they sell a lot of cars. They sell a fraction of what Ford or GM or any of the big players sell, but because they have data on every mile ever driven in one of their vehicles. And so when you talk about, okay, how do we make the product better? How do we know what consumers want? How do we create something? It's that data. When you talk about how you can go to the internet and search anything and have information at your fingertips immediately, and it doesn't cost you a penny to run that search, what's actually happening is that the information that you're searching is being packaged and sold to advertisers. And so let's not pretend that we're not doing it too. And let's not pretend that we don't monetize it. And in fact, the foundation of many large US businesses is monetizing consumer data. And so I think the question gets back to who are the actual customers of these firms, right? Who's the customer of China going to be if they want to sell that data? What are they selling and why? And in many cases, the end users aren't the customer, we're what's being sold. And so I guess the challenge in addressing China is not so much what do they do versus what do we do? It's, okay, more from a state actor perspective, right? What are they going to try to do to take down our governmental systems? What are they going to do to try to take down, a lot of the foundational pieces of business in our economy? I don't necessarily think that them knowing that I searched for, a nail clipper for my dogs is a piece of information that's going to be all that important to them. In aggregate, they certainly can package that data and sell it, but we've been doing that for a long time. And so what can they do? They can do a lot. Remember that there's a lot of recourse in a lot of different ways for us. And again, I think we've already been doing a lot of that to ourselves.
Tony, you got anything on that?
Yeah, no, it's a good summary. I mean, I totally agree. Facebook's been doing it for years. If I go on Facebook and I search for a car, or excuse me, I'm on Google searching for a car, the next thing you know, my Facebook feeds, I'm looking at the cars I just looked at. So yeah, it's all about information, who's controlling it. Obviously, with China, in terms of just the data and the free trade, those are big concerns. We want a equal trading partner if they want to trade with us. So there's pros and cons to both sides of it, but Kyle hit it on the head. It's I guess your perspective of who's controlling the data and what's right and what's wrong. It's a tough one.
One of the things you brought up, Kyle, is actually that moves us to another question that's come up. Actually, I thought that Tesla made its money from selling climate credits, from selling carbon credits, because of what they're doing. I thought that's where their biggest money comes from. But brings up the question about what do you guys see in terms of your stocks and climate change and how things are happening with that? And a sidebar to that is the social investing. So two sort of more, a little more politically charged, perhaps, questions, but what do you do? How do you approach with climate change, and what do you do about social investing? What do you see that happening?
I mean, I'll start big here and work little. And that is, when you talk about social investing, the landscape today is very different than the way that it started. So you look at apartheid in Africa as one of the driving forces of early social investing. And you essentially had investors who said, I want to divest of any business that has any kind of interest in apartheid Africa and apartheid South Africa. And so what you got is, in the early days, social investing that was entirely based upon exclusion, right? I don't want this business, but anything else is fine. What we have today is an investment landscape that can do just about whatever you want. If you've got a particular social concern, if you've got a particular governance concern about what these businesses do with their money, you can just about explore any one of those. There are literally hundreds of what are now considered socially responsible investments, whether it's green energy, clean energy, workplace funds. There are investment vehicles that capture every one of those concerns. And so I think it's clear that this is something that especially younger investors want. It's a conversation we have pretty regularly. We publish a podcast on a weekly basis that I'm on. We publish videos to our website pretty regularly. Certainly it's a topic that we talk about regularly in those forums. But more importantly, the early days, it was very expensive to do that. If you were only excluding companies, you had to add additional tools to be able to do that, which added cost. And B, it meant that you missed pieces of the market. What we're realizing today is that if you invest in a company that long-term is more viable, right? The difference between a solar energy company and an oil company, right? Oil, eventually we're going to run out. And what does that business do? Solar energy, the sun's going to be around for a lot longer. And so if you invest in a company that's more viable, that's more responsible in their practices, they're less likely to have regulatory issues. They're less likely to have a business that suddenly becomes out of favor. Potentially, you're adding some value in that way as well. And so the costs have gone down drastically, both in terms of actually implementing what you'd like to implement and in terms of, the opportunity cost. As you get into the specifics, I mentioned you can do just about anything you want today. If you want a fund that doesn't have nuclear energy, you can do that. If you want a fund that doesn't have small arms, you can do that. If you want a fund that doesn't have, coal, or that doesn't have things like that, all of those are possible, down to Catholic values funds, down to, Jewish values funds. Those are all things that you can do as an investor. And so from a landscape, incredibly encouraged about the direction we're headed. I think the more nuanced part of that conversation is long-term viability, right? That if you're investing in sustainable businesses, and how you define sustainable is fairly broad, but I think of it as companies whose businesses won't be legislated out of existence, who won't run out of the raw materials that they need to actually produce what they're producing, and ultimately who aren't going to be sued into oblivion because they're polluting or because they have a toxic workplace or whatever it is. If you're investing in businesses like that, long term, you've got a business that should be successful as long as all the other pieces are there, right? We talk about these constraints and you put those in one bucket, but there's also the fundamental aspect, right? And so there's a lot of really great businesses that are never going to make money. There's also a lot of really great businesses that are going to make a lot of money. And the key is to align yourselves, at least as an investor, with both. Now, you can certainly, save, you can certainly donate, you can certainly give to other areas. And we definitely encourage people to do that. And that's one part of this conversation, is what you do philanthropically. From an investment perspective, you've got to align the social values with the fundamental basics.
Yeah, totally agree. Yeah, totally agree. ESG is not a big area for us. I think we're at about $8 million out of our $2 billion where we do specifically ESG. We have had clients ask for it. It's on a mutual fund platform. So we'll go into Morningstar and screen based on that criteria and put a portfolio together, but it's not a big part of our business. And to Kyle's point, you can if you have specific areas that you want to like contribute to in gift, that at times can be more advantageous doing that. So you can really isolate and give from your portfolios versus investing in those areas, and whether or not they're sustainable or there's regulations that are going to prohibit those industries. Another way you could do it, I guess, is to get individual equities and screen out that way, but it's not an area that we really focus on.
Okay.
Tony mentioned Morningstar. Just briefly, Morningstar is this incredible data firm down in Chicago that can essentially take the millions and millions of data points that are available to investors and aggregate it into this system that allows you to access it. And it's an incredible tool for people like Tony and I to be able to say, here's what you have, here's how it's done. But one of the things I love about Morningstar specifically is they've partnered with a company called Sustainalytics, actually bought Sustainalytics, which is a firm that has all of this data on these ESG criteria. So we can know a lot more about investments today than we could even 3 or 4 years ago in the form of, scoring on various environmental, social, and governance criteria. And more importantly, right, compare that to other investments like them, right? So it's one thing to say this fund scored very highly. It's another to say every other fund in its category scored as high or higher. And we know that, as an example, growth-focused investments tend to score a little higher. Technology companies don't have a large carbon footprint typically, as an example. And so if you're talking about not just an absolute, is this a responsible investment? Because ultimately that's a very difficult question to answer. These are very gray areas. We can get down to the nitty gritty with data from Sustainalytics via Morningstar. We can get down to the nitty gritty of, here's how these companies, here's how these funds that invest in these companies actually score. And so the tools and resources available to people in our industry are so much greater than they were. We can better answer that question and give you, I think, a more informed answer on that question than we could, even within the past couple of years.
Wow.
Absolutely. Yeah, absolutely. The challenge is when you have a mutual fund that qualifies for ESG and they hold 100 names, let's say, any analyst can come through and pick apart one of the names. So you might want to, a technology company that creates laptops, eventually the laptop is going to be old. So where does it go, right? Into the landfill, or how are they recycling that? So you can really dig. I mean, you could pick apart those parts of the portfolio as well. So you just got to be comfortable that it's not going to pass probably every single ESG component, but that their goal is to get the portfolio aligned with as much as they can. That's the challenge.
Well, you guys, we're coming up to the witching hour here, and I want Dennis to say some last words, but I really want to say thank you. It's really educational, a lot of good questions, so many different topics, and you guys, it's nice to know there are people out there like you who are thinking so broadly, both of an equity as well as diversity, and every need of people up and down the spectrum. I think is amazing. I've learned a lot. I really, really appreciate it. Dennis, I'm going to turn it back over to you. And Kurt, thanks for setting all this up too. Kurt's idea to pursue, after all the feedback from the modern monetary policy and looking at this and worrying about where we're going as a country. So Kurt, you anything, Kurt, before we give it to Dennis?
No, this is great, you guys. Appreciate it very much.
Okay, Dennis, it's yours.
Yeah, I'd add my thanks on behalf of the Plato participants. A big thank you. This indeed has been very informative, very thoughtful, and no pun intended, very rich kind of discussion. So thank you so much for not only your time, but the thought that you put into this, I know, every day, and what you shared with us this morning. So we will be meeting again, meeting in quotes, 2 weeks from today. And the topic is going to be something we covered briefly this morning, and actually cover a lot of times, and that's information, misinformation, role of the media. And I know that's a topic that we've covered in pieces before, and we'd like to sort of have a nice focused discussion on that a fortnight from now.
A fortnight.
A fortnight. Okay, so
Thanks.
stay well, everybody. Mask up. Take care.
Bye-bye.
Thank
Bye now.
you.
Bye-bye. Thank you.
Thank you so much.
Thanks.
Bye now.
Yeah, thank you.
Dennis, what'd you think?
I thought it was great.
Yeah,
I really did.
that that combination of a back and forth,
Yeah.
getting an actual panel going.
Yeah, that really was a very good format, and both those guys were very good. They really provided a nice compliment to one another. So
Yeah,
thanks
yeah.
thanks for getting us started on this, Kurt.
No, it's all good. Thanks for doing it.
Yeah, sure.
I'll talk soon. Enjoy the weather.
Okay, well, you too. Enjoy the snow, not the ice, but the snow.
All right, I'll see you, Dennis. Bye.
Yeah, take care.